You ever see a stock price just take off and you're left wondering what is actually going on under the hood? Well, that's exactly what we're going to do today. We're going to use one stock's absolutely incredible journey to unpack the core tools of technical analysis. And we're going to see what they tell us when the signals start to contradict each other. So let's start with the headline number, the one that makes you do a double take, $57.75. That's where this stock, IREN, peaked back in October. Now get this. Just 3 months earlier, it was trading for less than $17. That is a gain of over 200%. So the big question is, was this predictable, and what kind of clues did the charts leave behind for us? So here's how it all played out. The climb started pretty steadily in July, but the real fireworks, they kicked off in late September. That's when the stock just blew past a key psychological level at $47. And then it peaked only a couple of weeks later. I mean, this is the kind of explosive move that puts every single trader on high alert. All right, let's start our investigation. We're going to begin by looking at the most basic data points out there, price and volume. What kind of story do they tell us? A huge price move like this, it doesn't just happen in a vacuum. One of the very first things an analyst looks for is trading volume. Think of it like this. Volume is the fuel for the rocket. A big price move without a lot of volume, that's a little questionable. But a price move with a ton of volume, that shows real conviction from investors. And yep, the data for IREN backs this up perfectly. On the days with the biggest price jumps, the trading volume was absolutely enormous. I mean, we're talking tens of millions of shares changing hands here. This was no fluke. This was a crystal clear signal of some serious enthusiasm, with a torrent of money pushing that stock higher and higher. Okay, so we've established a powerful move, and it's backed by heavy volume. The next question is, how do analysts actually measure the health and the strength of a trend once it's already going? Well, they use a tool called a moving average. So a moving average is a core tool in any analyst's kit. You can think of it as a way to just ignore all the day-to-day noise and static. By averaging the price over a set period, you get this much cleaner line that shows you the true direction of the trend. Is it going up, down, or sideways? And for IREN, wow, the signal could not be clearer. At $57.75, the price isn't just a little bit above its short-term 5-day average, it is dramatically above its 20-day, 50-day, and even its 200-day average. When a stock is outperforming its own history across every single time frame like this, analysts see that as an incredibly strong, bullish signal. So the trend is strong, for sure, but is it maybe moving too fast? Let's dive a little deeper into the specific gauges on an analyst's dashboard to measure something called momentum. First up is the RSI, which stands for Relative Strength Index. The easiest way to think about this is like it's the stock's speedometer. It doesn't just tell you the direction of the trend, it tells you how fast it's accelerating. It helps you answer the question, is this move getting exhausted? And IREN's current RSI reading is 81.98. Now, that number might not mean much to you on its own, but in the world of RSI, believe me, that is a very, very big deal. So here's the crucial part. Any RSI reading above 70 is considered overbought. Imagine a car engine that's running deep in the red zone. Sure, it's performing at its absolute peak, it's incredibly powerful, but it also carries this major risk of overheating and needing to cool down. That's exactly what an RSI of nearly 82 is screaming to analysts. But hey, analysts never rely on just one indicator. So next up, we have the MACD. It's another momentum gauge, but it works a little differently by looking at the relationship between two different moving averages. And right here, this is where our story gets really complicated. Because while the RSI is flashing this major warning sign, the MACD is telling a completely different story. Its value is way above its signal line, which analysts read as a bullish sign of increasing positive momentum. The MACD is essentially saying full speed ahead. So now we've got a conflict. One gauge says caution, the other says go. Let's put all these pieces together and actually look at the battle that's raging between the bull and the bear signals. This slide right here, it just captures the analyst's dilemma perfectly. The bull case is clear. The MACD is positive, the price is soaring above all its moving averages, everything looks great. But the bear case is just as strong. The RSI is deep in overbought territory, and a bunch of other momentum indicators are flashing that same warning sign, all suggesting the stock has gone way too far, way too fast. So, with such a clear divide in the data, how does an analyst even begin to forecast what might happen next? Well, let's take a look at the possible scenarios. Based on all the evidence we have, it really just boils down to three possible paths. The bullish scenario is that this incredible momentum just keeps going, breaking past the recent high. The bearish scenario is that those overbought signals finally kick in, triggering a pullback and sending the price back down. Or we could just see a neutral scenario, where the stock kind of churns in place as the two sides fight for control. We can even get more specific for just the very next trading day. Using a measure of the stock's recent volatility, which is basically its average daily price swing, analysts projected a potential range for IREN between roughly $53 and $61. That is a really wide range, and it just reflects how much uncertainty was in the air. So after all this analysis, after looking at all the charts and all the indicators, what is the big takeaway here? What is an investor supposed to do? The final conclusion from the source analysis really reflects that central conflict we uncovered. The advice is cautious. It suggests that if you're already in the stock and you've made money, maybe it's a good idea to take some profits off the table. And if you're thinking about getting in, it might be wise to just wait for the price to cool off a bit, acknowledging those very real overbought warnings. And, that really leaves us with a final thought. We've seen how powerful these technical tools can be. But when the data itself is contradictory, sending clear signals for both optimism and caution, it really forces us to ask this question: how much of this analysis is pure science, and how much of it is actually the art of interpretation?